Hi, my name is Jack Fagan, and I'm a member of the investment team here at Osborne Partners. And on this video, I'm going to go through a review and preview for our natural resources and alternatives asset classes. Let's get started. So starting with natural resources in 22, it can be summarized by saying agricultural and energy prices surged amid Russia's invasion of Ukraine in February of 22. That set the stage for the remainder of the year, and the entire commodity complex saw price surges and volatility really throughout the year. This chart shows but just three of commodity prices, starting with natural gas, which nearly tripled into the deep summer months. WTI crude, which peaked in March just after the invasion of Ukraine, up nearly 65% year to date at the time, as well as the green line being an agricultural index, which looks relatively subdued comparatively. However, within that index, prices for key commodities such as wheat and soybeans experience its own price volatility throughout the year, up nearly 60 and even 70% year to date at certain points in the year. Moving into alternatives, now this asset class is typically used to hedge certain risk factors such as credit, currency, or interest rate risk. And last year was ultimately defined by the Federal Reserve's hiking cycle, which ended up being the fastest on record. That led the USD to strengthen to a nearly 20-year high in the third quarter. You can see that within the red circle on the chart below. Now, for 2023, here are 5 key themes we are thinking about. And while not unique to natural resources, they each have a relationship to either natural resources or alternatives. So starting with number 1, kind of the key theme on most investors' minds are what is and how long is the path to peak US rates? And then once we get there, how long will we stay there? And ultimately, how soon once we pause hiking rates until the Federal Reserve ends up cutting rates? Now, those factors will have a direct relationship with the path of the US dollar, whereby last year we saw rising rates lead to a strengthening dollar. This year, we may see peak US rates and a pause period, which will have, a very different impact on the dollar. Number 2, and relatedly to the Fed path, is does the US economy find a soft landing? Do we enter into a recession? Maybe somewhere in between. 3, the impact of China's reopening on not only global growth, but also ultimately the balance of commodity prices and supply and demand, as China is the largest consumer of most commodities in the world. Number 4, geopolitical stability or lack thereof. For this, I have in mind 3 key regions, one being Russia and Ukraine, 2, areas of South America that are key commodity producers, and 3, China, which again is a key commodity consumer. So kind of the path of those 3 regions will be telling as it relates to the overall supply and demand balance for commodities for 2023. And last but not least is sort of the key theme for me as it relates to natural resources for the year, which is the generally constrained commodity environment we find ourselves in. So jumping into a preview for the year, starting with the dollar, as mentioned, the U.S. Federal Reserve may be reaching peak U.S. rates, perhaps as early as the first half of this year, and then expected to maybe pause, and if you listen to the Fed, will remain higher for longer for a period of time. Or maybe if you look at the market, then we may see cuts as early as by the end of the year. Ultimately, that rate differential between the US and the rest of the world will be a key driver for the US dollar in the year ahead. Moving ahead into commodities, starting with industrial metals, this slide depicts where we are presently heading into 2023 in terms of the inventories to start the year. So on the left-hand chart, you can see copper, which is a key industrial metal. That blue line at the bottom was 2022. You can see the lowest of the visible copper stocks in many years. And on the right-hand side, the London Metals Exchange inventories fall to at least a 25-year low. So presently, we're entering the year where we may see increased demand and increased economic activity, but with inventory levels that are well below kind of normal run rates that we've seen in the past. Taking a further look into the balance between supply and demand for industrial metals, we see the bottom left chart, copper is expected to remain in deficit for the next several years, while on the right-hand side, we see the balance of aluminum is again going to be highly dependent on the path of the Chinese economy and ultimately the demand out of that region. So taking a look at that bottom right chart, that light blue bar is the ex-China aluminum balance, modestly positive. However, if you include Chinese impact onto the aluminum balance, it goes modestly negative. Moving ahead into the outlook for oil. So despite the higher prices last year, which had a great impact on energy and oil companies' free cash flow, stock prices, that would typically in the past would lead to an expansion of CapEx spending, which over the medium to long run should increase supply and thereby lower prices. However, based on the bottom right chart, you can see that we haven't really seen that resulting CapEx boom that you would expect. That dark blue line on the bottom right chart has been trending lower since 2015 and represents that oil and gas real CapEx spending. So, this environment currently is one of lower CapEx spending. However, this may change. And you can see a Dallas Fed survey which has reported that 64% of oil and gas executives do plan to expand CapEx spending in 2023, while just 14% expect lower spending. Now, moving into natural gas outlook, we see quite a different picture. The reportedly third warmest winter on record rapidly changed the expectation to reality of what the natural gas market was supposed to look like if you go back just a few months. So looking at the chart on the bottom left, that red line shows that prices plunged into 2023, again, based on better weather, lower demand for natural gas, less heating needs. And on the same chart, that dark blue line represents gas storage, which is jumping into 2023, in fact, above the 5-year average, which is the first time since about 2020, except for a blip at the end of 2021. On the right-hand side, that chart depicts basically the same message in a different way through the futures price curve, whereby that blue line is shifted lower, which represents the price curve as of the end of January. And the gray line was the pre-winter futures price curve, which was, again, much higher, representing a tighter, higher price supply environment. Moving last but not least into precious metals, specifically gold, as shown on this chart. Historically, the price of gold has a very close relationship with real interest rates. So as the dark blue line on the bottom left chart goes higher, which is the price of gold, you can see that is tightly correlated with the light blue line, which is lower real interest rates. Now, you can see the chart flips in 2022 as the Federal Reserve starts hiking rates, the price of gold drops, real interest rates rise. And we expect that relationship to hold in 2023, which ultimately begs the question, where do rates go this year? For a more in-depth look at that question, I encourage you to look at a prior video of this series done by my colleague on fixed income. So that concludes our outlook for natural resources and alternatives. I appreciate your time and sitting with us on this video today. And I encourage you to look through the slide deck, as well as be on the lookout for the last video of this series on real estate, hopefully coming out soon. So thank you again, and have a great day.